Let's start off with the Fed, because that's what everyone is talking about right now, and the fact that we've seen gold hit new all-time highs this week, and the fact that the dollar is weakening. A lot of talk about a second round of quantitative easing. Do you think we need more quantitative easing?
Well, I think it's worth remembering what's happened in the past. Of course, the Federal Reserve have been very aggressive, very innovative in terms of coming up with solutions to deal with this crisis. They've already spent $1.7 trillion buying long-term government and mortgage-backed bonds. So they have been pretty aggressive in this space already. And there was real hopes, of course, from analysts that that had done the trick. The US economy was growing. Remember, it grew at more than 3% during the first quarter of this year. However, as we know, we've certainly seen some far weaker data points more recently. Growth came down to 1.6% in the second quarter. Unemployment still remains elevated, 9.7%. Inflation, very low indeed. So it wouldn't be a surprise if the Fed were once again looking to use some incentives to try and ensure that the recovery is as strong as possible.
Well, Henk, don't you think this is going to create more systemic risks down the line? Because essentially, if you are embarking on more quantitative easing and more stimulus of this kind, then surely all you're doing is increasing government debt, and somehow you have to pay that off down the line.
Well, I think that is one of the biggest problems you can point to in terms of the risks looking out on the short to medium term, is the fact there's a huge bill to be paid for the solutions that have been implemented in the past couple of years, because we know effectively authorities have been mortgaging the future to pay for the present. But you're right to say those bills will eventually land on the mats, and I think that's the process that's taking place at the moment. So in some ways you feel like saying goodbye financial crisis, hello fiscal crisis, and that's certainly a big concern in terms of the trajectory of growth for the global economy, as I say, in the medium term.
Well, we were talking a little earlier, and you were talking about the stability of the US economy, and you said that the US hasn't really been rewarded for its bravery. Let's take that statement and just look at what the US has been doing, because we have been seeing short-term stability, but the question is, are we going to be seeing longer-term stability with all the stimulus that has come to the fore? Could it create another crisis, as a fiscal crisis, as you mentioned?
Well, what we've seen from the Federal Reserve is the fact that, of course, they've taken interest rates very early on in this process practically back to zero, so it's been very accommodative. They've also told the markets they anticipate the rates will remain at those exceptionally low levels for an extended period of time. And of course, authorities have implemented a huge stimulus package, $800 billion worth. And we heard once again, more recently, President Obama dipping back into that stimulus bucket once again, announcing a further $50 billion worth of stimulus. So I think they are working very hard. There was real hopes the US economy was going to be the developed market that led us out of this recession. It's still probably going to be the case, but not such in a robust form as we anticipated. But we're probably still talking of growth of around about 3% during the course of this year. Certainly better than we anticipate from the UK or even the Eurozone.
Well, Henk, just looking at the unemployment factor that is playing out in the US, and we had those consumer confidence numbers, or sentiment numbers out of the US on Friday, really showing that the US consumer is still very much under pressure. Even if we do see more stimulus in the likes of quantitative easing, is that going to have the desired effect? Because it seems that without stimulus, especially when it comes to the housing market, things fall apart.
That is the problem, of course. We know that unemployment, as we said, is at elevated levels. Pay growth has slowed down quite considerably. So there's still considerable pressure on the developed market consumer. Remember, we've come through a decade of getting drunk on credit, but now we're almost in that hangover situation. So in some ways, I suppose we've got to recalibrate.
Aren't governments now getting drunk on credit as opposed to the banks and the consumers?
This is true. But in some ways, you feel you've got to recalibrate your expectations about how much demand can really be generated from the consumer. But remember, it's still a very important factor. The most important factor in the global economy, the US consumer, accounts for a quarter of global consumption.
So do you think we're going to be seeing a recovery when it comes to the US consumer?
I think we're talking about anemic growth coming through in terms of the demand that you can expect from the US consumer. Yes, they're working hard. Interest rates are very low. They're going to be very accommodative. That should help the consumer. Are we really going to go back to those boom days that we saw just a few years ago before the crisis? One would suspect not.
Well, looking at the low interest rate environment, because one of the reasons that banks are relatively stable is because of all the monetary policy and the accommodation that we have been seeing over the last while. Do you think perhaps it could lead to another boom-bust scenario down the line? Because we saw what happened when interest rates were held too low for too long at 1% under Alan Greenspan.
Yeah, that does remain a concern. Listen, I think in the short term, what you're going to be seeing is authorities working hard to ensure the speed and strength of the economic recovery, particularly when they see those weaker data points, perhaps that will force them into action. The longer term concern is that much of this effort will start to generate inflation, perhaps 3 to 4 years. The good news there is that central banks have certainly proven themselves very adept at dealing with inflation. And of course, that isn't the worst case scenario. The nightmare scenario they're all fighting against is the threat of deflation. And that is why you're seeing them perhaps overdoing the stimulus in the short term, believing they can deal with those results rather than risk the potential for a downward slide into deflation and that negative scenario of a double dip recession.
Okay, well, are you ruling out a double dip scenario?
We certainly don't believe a double dip scenario is on the cards. There's no doubt there are risks to the recovery in terms of the global economy. But given the fact we've got huge stimulus packages in place, very accommodative interest rates, the fact that we will continue to see these quantitative easing programs, if necessary, should create an environment in which the economy can grow. Below trend, one would suspect, anemic economic growth, but we're not going to be going back into that double dip recession.
Looking at gold hitting new all-time highs, and it has been relatively comfortable over the $1,200 an ounce level for quite some time. What is your view? What are you telling investors right now in terms of that asset class?
Well, while we're actually pretty positive about the complex of commodities, the one area we have become far more cautious on is the gold price. Now, we believe it's been very much driven up by the investment side of the equation. Easy to understand why investors have been piling into gold. They see it as a safe haven status. They see it as a hedge against the inflation that we were just talking about, and of course taking advantage of the weak US dollar. But I think there's a real bubble that's been developed within the bullion market. You only have to look at exchange traded funds to see how aggressive they've been in terms of building up positions within that market. But that's really been disguising what looks like a pretty weak physical demand in terms of gold for jewellery, for example. Jewellery demand was down 23% last year, the lowest level in 21 years. So it's really the investment side of the equation. When you look at the marginal demand for gold from an investor perspective, it accounts for around about 30%. That's 3 times higher than the medium-term average.
Of course, we know that central banks have, of course, been buying gold this year, net buyers of gold as opposed to net sellers.
Well, you have seen an element, I think, of diversification from India, for example, buying into gold as they've been concerned a little bit about the US dollar. But in general terms, that investment side looks way too strong, and that crisis premium will eventually have to come out of that market.
Emerging markets versus developed world, looking at the equity scenarios that are playing out at this point in time, where would you be putting your money?
We still remain positive about the prospects for equity markets in general. That's based around 3 major principles. The first one is the bright outlook from the corporate perspective. We expect the global quoted corporate sector to bounce back in profitability terms of 38% during the course of this year. Interest rates remain very low. Dividends, of course, that equities pay look very valuable indeed. And actually, if you look at valuations, they're below their 10-year average. So in general terms, still very positive, particularly about developed markets. But actually, from the start of the year, it's probably until in the first half of the year, we've been saying developed markets, because emerging markets simply pricing in too much good news already. But actually, valuations have come down in emerging markets. So I think in the second half of the year, we can be still a little bit more positive about the prospects for emerging market equities as well.
And in terms of bonds, such as South African bonds, this is why the rand has been strengthening extensively, not so much flows into our equity market, but more into our bond market. Your view on that in emerging market bonds as a whole, and given the fact that the risk factors are pretty much similar to what we've been seeing in the Eurozone, or the yield is pretty much similar to that of the Eurozone, but the risk factor seems to, create more appetite for emerging market bonds.
Yeah, I think that's right. The reality when it comes to government bonds is they look very expensive. They're a very poor performer last year. We know more recently they've performed better because there still is economic uncertainty out there that's been reducing risk appetite, and the extension and speculation of those quantitative easing programs, the fact that they could be extended, certainly been encouraging some of the yields to go a little bit lower. But longer term, I think it's worth remembering that actually the supply and demand equation means that issuance has gone through the roof. Demand will start to fall back as quantitative easing in a year or so will start to be reduced. So our expectation is that yields will start to rise and therefore prices will fall. But it's worth remembering, if we do see a big risk to the economic recovery, if we do see a major disruption, our expectation is that long-term quality government bonds will be the best performing asset. So in a balanced portfolio, remember that's incredibly important in these uncertain times, in a balanced portfolio, they'll certainly provide a valuable piece of insurance.